Is the Temecula Murrieta housing market turning into a buyer's market? And what the heck is going on with interest rates? Are we in a housing bubble? I'm tackling these questions and more in today's Trench Report. Hi, Jessica here from the Genung team in Active Realty. In my monthly Trench Reports, I dive into some housing market news, and I also share with you what's going on in our personal business to give you some insights from the boots on the ground. So let's start with the feeling in our personal business and some stats. The market is definitely showing some signs of relief for buyers, and it's making sellers that are needing to sell a little bit more anxious since the first time since about 2019 when it was a little bit more balanced. On the buy side, we are up against much fewer offers. Oftentimes, we are the only offer on homes right now unless it's a hot home, it's in a hot neighborhood, or it's a particularly competitively priced property. We are negotiating more repair credits from sellers, and we're not having to waive many contingencies like before. The volume in our personal business is down. It's actually at a nice steady pace currently, but of course we don't want it to slow too much. We have 12 pending transactions currently. Compare that to our career high of 31 pending transactions, which was in November of last year. Keep in mind about half of my business is new construction, so not all of those transactions were closing that month, but about half did close in November, making that our biggest month ever. Last year was kind of a blur, quite frankly, and we realized that we needed help and we started our team. Buyers agents and former clients, Scott and Chris, joined our team last year, and showing assistant Christina joined our team this year. We are so thankful to have such awesome people helping us serve our clients. Let's talk about how things are going for sellers lately. The shift is pretty new, by the way. It started about a couple months ago. The beginning of 2022 was still really nutty and crazy busy. That was before the Fed started raising the interest rates, which is the cause of the cooling. In my opinion, the speed at which the Fed is raising the rates is likely to push us into a recession if we are not already in one. This is what typically happens when the Fed raises rates if you look at economic history. Most of the time the Fed raises rates, the US economy did go into recession, then the Fed lowers the rates back down, and this typically is successful in bringing us out of recession. More on this later in the video. So if we do enter an official recession and the Fed feels as though we're entering a prolonged economic slowdown, they are likely going to start to lower the interest rates again. The common analogy among homebuyers currently is to marry the house and date the rate. The hope is that the rates are going to reduce and then they can refinance into a lower rate. This is a much easier time to get an offer accepted on the home of your dreams because there is less buyer competition. Let's talk briefly about what it's like to be a seller in today's market. For starters, overpriced listings are not selling like they were before. Smart pricing is very important for sellers who want and need to sell. You want to be priced at market or even slightly under to drive buyers to view your home. Speaking of driving buyers to listings, we are having to ramp up our marketing on our listing because gone are the days of listings selling themselves. We're doing lots more open houses, for example, which we were not doing a whole lot of during the pandemic, in part because they were not allowed for a certain amount of time. We're having to invest in more for sale signs and lock boxes because homes aren't flying off the shelf like before, and we are purchasing more open house signs and materials because we are ramping up the frequency of our open houses. We're also doing more social media marketing campaigns for our listings and trying to tap all of the tools in the toolbox to help our listings stand out from the crowd. Let's talk about Zillow, Zestimates, and other website estimated pricing. Take these pricing estimate tools with a grain of salt, please, because they have been so inaccurate lately and it's actually caused some difficulty in our business. We suggest a price to our sellers and sometimes they are disappointed because Zillow had the home at a much higher price. Keep in mind the Zestimates are just an algorithm and your real estate agent will run a much more comprehensive report than an algorithm will provide and be much more accurate. These estimates have been so off lately that I decided to see what Zillow had to say about my own home here in Murrieta. It was over $100,000 more than I think that I could get for the home on the open market. Keep in mind that the iBuyer business for Zillow just went under because they could not properly value properties and they overpaid. It was something like $500 million they lost, and Zillow shut that portion of their business down several months ago. I have mentioned this before in other videos that our firm, Active Realty, had the exclusive relationship with Zillow to resell the homes the public would sell to Zillow in Riverside, San Diego, Orange County, and San Bernardino. Chris and we were not the assigned agents to handle these properties over the last couple of years, but we tried to stay in the loop of all of it anyway. It was a nice source of inventory while it lasted. Let's talk about interest rates, and then lastly, we'll talk about if we have a housing bubble brewing. Interest rates, they have been so volatile lately. I have even seen full point fluctuations within 1 week. Also, lenders, they've been announcing midday rate changes, often 2 or 3 times each day, depending on market conditions. Because of all this volatility and rate increases, it is very important that homebuyers have their pre-approvals updated when the rates increase to make sure that you can still comfortably afford the price range that you're shopping in. 30-year rates have been fluctuating between about 5% and 6.2%. By the way, if you are finding this information helpful, if you could let me know by clicking that like button down below, I always really appreciate that. So I consulted one of my lenders, Dale Walker, about his opinion on where the market was headed. You might remember Dale from a video we made a while ago. By the way, I have 2 lenders I work with regularly, and if you need a great lender referral, be sure that you reach out to me, shoot me an email, and I'll be glad to send you their contact information. Both lenders are really great and I highly recommend. Lender Dale and lots of folks in the mortgage business follow an industry expert named Barry Habib. I will spare you Barry's biography, but he's a very trusted resource for loan officers, and he delivers daily market analysis and economic news, and he also has a really good track record for predicting what's to come in the market. After the last Fed meeting, Barry did a recap, and here is that info. The result of the 2-day Fed meeting was a 75 basis point hike in the federal funds rate, which is what the market was hoping for. The reaction was both positive for equity and bond markets. The original projected rate increase was only 50 basis points, but after the higher than expected inflation numbers came out, the Fed got even more aggressive with the rate hike, which is what the markets were hoping for. The hike was the largest in 28 years. The Fed has also said it plans to do another hike of 50 or 75 basis points at the next meeting, which is in July. The media dot plot shows the federal funds rate at 3.4% at the end of the year, which means another 175 basis points over the remaining 4 meetings. Barry thinks this could break down to 75 basis points in July, 50 in September, and 25 in both November and December as an example. One important thing to note that Barry points out is that as inflation goes up, so does mortgage rates. When inflation goes down, historically, interest rates go down as well. They have the unemployment rate projected to go 3.7% at the end of the year, which is only 0.1% higher. Barry says this is highly unlikely, especially with the most aggressive hiking cycle in 40 years. So in other words, the Fed is not being realistic on the unemployment rate remaining as low as it is. They are predicting GDP to be 1.7% this year. Meanwhile, we saw minus 1.5% in the first quarter, and the Atlanta Fed just adjusted their second quarter forecast to 0%. So this doesn't sound very realistic either. So Barry believes the path for a soft landing or avoiding recession is not possible. Does he believe that we're in a housing bubble? I'm going to link a very helpful presentation down below in the description where he breaks it down with data, but not data that's going to put you to sleep. Very poignant and simple charts that are very informative. He has a subscription service that a lot of loan officers pay for, and it's not cheap, quite frankly, but this video, it's available for anyone to watch. He does not believe we are in a housing bubble for many reasons, including that we still have a housing shortage and because of the new household formation stats. Check out the full video in the link for more explanation on this. You have to be so careful, myself included, of the media and the content that we consume. With all of the bad news lately, I have felt my anxiety rising too. The fact of the matter is that a lot of news is just trying to be clickbait worthy, shocking in order to get you to click, and it can be unhealthy. Negative titles, they get way more clicks. I admit a lot of these doom and gloomers, they seem so smart. Have you seen any of these channels? You have to stop and think if there could be an agenda with the info shared in a video. Does this person sell gold and it might be beneficial to talk about a market or a fiat currency crash? Do they sell investment funds? And if they communicate a coming equity market crash, maybe they can show that their portfolios are better positioned for a downturn, and maybe you're going to move some of your money into their funds. I would be curious, what are your favorite YouTube channels for real estate and economic news that you trust? Leave me a comment down below in the description. I'd love to check it out. I want to quickly talk about an article in the Press Enterprise that was just published on June 21st that caught my attention due to its title. It read, Riverside County home buying tumbles 12% as housing payments soar 48%. With that being said, prices were still up 1.4% on the month. We are not crashing, and I see very few people predicting a 2008 style decline, but titles like this article can certainly get some clicks. I'll link that one down below too if you're curious. With all that being said, the housing market seems to be normalizing. Prices are still increasing, but at a slower pace, thank goodness. But we are likely headed into a recession by later this year or early 2023, which will probably lower the rates back down if we follow historical patterns. Also, we're likely in for a bumpy summer with a rapid rate increases. Hope this video was informative and helpful to you, and we'll see you next week. Bye.